It's a fact that everyone loves a bull market, but discipline goes for a toss in a roaring bull market. We see the markets climb, fear of missing out kicks in, so we buy onto the market, paying no regard to fundamentals or valuations, making a huge mistake that's going to cost us. Join us this coming Saturday where we talk about keeping a check on your behavior in a bull run.
When does a defensive sector become risky? Firstly, why do we look at defensive sectors? We look at defensive sectors because we feel that we cannot lose money by investing in them. So, we feel our capital is better preserved and likely to be protected in a defensive sector. So, what are these defensive sectors that we generally prefer? The most obvious defensive sector historically has been the FMCG sector, the fast-moving consumer goods sector. Over the years, pharma also became a defensive sector, and later, information technology began to be seen as a defensive sector. So, broadly we can say that these three are defensive sectors. I would also add a fourth category, which is assorted businesses which don't need capital and can share the profits with shareholders more regularly and in a higher proportion. So, broadly these are the defensive sectors that we identify with. But a defensive sector can become a risk. It can become so risky that we could see a lot of temporary drawdowns. When would this happen? This would happen when we buy a defensive sector at a valuation that is higher. The same defensive sector can give you superior returns if you are able to buy it at a very low valuation. So, if you buy an FMCG business at 20 to 25 times, or a pharma company between 15 and 20 times, or an IT company between 12 and 16 times, then when that sector comes into favor, when the business sees a lot of tailwinds, growth is higher than normal, profitability is stable and improving, then the valuations trend towards the other extreme. They go higher and higher and higher, and this combination of higher growth and better profitability expands the P ratios, and this in turn leads to superior returns. That's the scenario from the bottom to the top. Now we are sitting near a top. So what is the current scenario? Let me describe the current scenario for you. Today, valuations are higher than they normally are. So the valuations are at the higher end of the band. Second, growth is at the lower end of the band. Third, visibility is coming down and predictability is going to be difficult. Lastly, margins can become compressed when growth is scarce, competition is intense, and people start rebating prices with customers. That is the scenario that we are moving towards in information technology. A year ago, everybody thought that you cannot lose money in information technology and overpaid. When they overpaid, the scenario was the complete opposite of what it is today. Attrition was highest, companies were making profits at a faster rate, and the profits were growing better, growth was visible, everything was in favor. So today everything looks adverse, and for the foreseeable future, we are not seeing this adversity lessen. In fact, it could rise. But we are blindly buying this sector, believing it is defensive. It is this behavior which is the risk that we are creating by ourselves. The behavior is the risk. Assuming there is no risk creates risk. And the valuations that we are paying now, which is in excess of what it ought to be, is the risk. So all these risks together can create a situation where we could see drawdowns in a defensive sector like information technology in the coming quarters. This is certain to happen if there is further deterioration in the fortunes of this industry and in the guidance. Also, this can happen if there is an overall derating of the equity as an asset class. And we seem to be moving in that direction where one or more of these things will come true, will become a reality and will come to bite us. This is how we have created a risk in a defensive spot, and this is how even a defensive business can be a portfolio risk. So now look at your individual investments and see where the risk is higher. If you have got 3-4 IT stocks, 1 or 2 must be sold because their financials could be weaker than the others and they would be more impacted than the others. Their business mix may not be favorably aligned to the emerging scenario. If all these things fall in place, you need to move to safety because your defensive investing is the risk to your own portfolio. Thank you for watching this video.